Hello everyone, I'm Tom and this is Thomas Money Magic. Today I'm going to be talking about the income and expenses that you would have to pay if you got an investment property. As you would have just seen, after my last vlog, I worked on the feedback that some of you gave me on what I should do with my intro animation, and I made it happen. When you get an investment property, which could be a residential or commercial investment property, you can get income through two ways, but you also have to pay some expenses. And your hope would be that all of the expenses total to a lesser amount than the amount of income that you get. But before you even start making income, you have to pay some expenses on the property. And then once you start earning income, then you have some ongoing costs. Purchase costs. These are the one-off costs associated with buying the property in the first place. So first of all, you actually have to buy the property. So to do this, you would pay a percentage of the price of the property as a deposit for the loan that you would have to get so that you could be able to afford the whole property. And the reason why you pay a percentage of that property is because it's called a deposit, and you have to pay it because in case something bad happens to the property, like you have to have a big repair, or you might not have enough money to pay off the loan, then they want to secure some money at the start so that they don't think that they've just given their money away to someone who will go and lose it. You also have to pay stamp duty to the government, which is a tax for buying the property in the first place. You also have to pay a title search, which lets the government know who the current owners of the property are. And finally, you have to pay legal fees, and this is just to tell the bank that the money that you owe them, if you don't pay off the loan over a period of time, then they have the ability to take the property away from you. Income. As I said in my recent video on the two types of property investing, which you can find a link to that video in the description, you can make money from property investing in two ways, that is, receiving rent and the property going up in value. Rent is the weekly amount that someone pays you for living in your investment property. The official name for the person or people living in your house is the tenants. The second way is by the property increasing in money over time, and this could also go down, but you're hoping that it would go up. This means that it's worth more when you sell it, or you would have the ability to pull out a loan called equity, which I'll explain in a podcast coming soon. Ongoing costs, also known as holding costs. The main ongoing cost for having an investment property is the repayments on the loan. This is also known as the mortgage on your property. I'll be making a podcast soon on loans, as I just said, and that should hopefully come out at some point during April, which will also explain this. There are many other small costs as well. When you own an investment property, you're called the landlord of that property. The landlord will usually pay a small monthly fee to someone else to look after the property for them. This person or company will find the tenants, they will collect the monthly rent, and deal with any maintenance concerns that the tenants have. This person is also called the property manager. It may be annoying that you have to pay this monthly fee to the property manager, but it does save a lot of time that it would take for you to do it all yourself. Every 3 months, you have to pay for the water that your tenants would use. Just to remind you, the tenants are the people that are using your property. Paying for the water bill is the same as paying for data for your iPhone when you're not on Wi-Fi. So let's say it was $250 every 3 months. If your tenants use more water than what the $250 would pay for, then they have to pay for that extra amount. That would usually be a higher cost than if it was part of the set amount. So this means that you only end up paying the $250 every 3 months yourself, but the tenants would have to pay for that extra if they went over the set amount of water. Other expenses include rates and taxes. This is a small amount that you would have to pay to the local council just to provide you with rubbish collection, building all the roads, or repairing them if something happened to them, and other stuff like that. And another unknown and sometimes unpredictable expense can be if something breaks within the house. So you would have to pay for that to get fixed, which could be a small amount or a big amount. And depending on the state of the property when you buy it, you will get more or less of these. and every year there can be 10 every month, or there could be none for the whole year. Another reason that you would have to pay for these maintenance issues or repairs is that there might be some sort of natural event like a big storm or floods or fires, all of those natural disasters that we get in Australia every year basically. After paying all of these, at the end of the year, you would just hope that all of your income that you receive during the year is more than all of those expenses that I told you about. And also, by the property going up in value, you would hope that pays off some of the purchase costs that you may have had to pay. That's all for me today. Thank you for listening. If you have any comments, questions, or feedback, please do that in the comment section below or on the contact us page of my website. That's all for me today. See ya.